Picture this. It's 1925, and a young lab assistant at a sandpaper company in Minnesota is trying to fix a strip of masking tape that painters keep complaining about. He tweaks the adhesive formula in his spare time without approval and invents one of the most widely used products in history. That company was 3M. And 100 years later, it's still doing the same thing, finding problems and engineering its way out of them. Today we're diving into MMM.
3M is one of those names that shows up everywhere without people realizing it. Post-it notes, N95 respirators, Scotch tape, automotive window films, semiconductor materials. The company has over 60,000 patents and sells products in nearly every industry you can name.
And right now, 3M is at a genuinely interesting inflection point. The company just reported Q1 2026 earnings that beat adjusted EPS estimates by nearly 8%. The stock jumped more than 4% on the news. CEO William Brown's turnaround is starting to show up in the numbers. Let's get into it. So let's set the foundation. 3M was founded in 1902, originally called the Minnesota Mining and Manufacturing Company. Yes, that's where the 3Ms come from. It started making sandpaper, of all things, in Two Harbors, Minnesota. Within a few decades, it was cranking out adhesives, abrasives, and reflective materials, and by the mid-20th century, it had become one of the most innovative manufacturing companies in the world.
Today, 3M operates across three main segments. Safety and industrial is the largest. That's everything from personal protective equipment to abrasive systems to electrical materials. Transportation and electronics covers automotive, aerospace, and semiconductor-related products. And consumer is what most people picture when they think of 3M. Post-it notes, Scotch tape, command strips, and similar household brands.
There's also the Solventum piece to understand. In April 2024, 3M spun off its entire healthcare business as an independent company called Solventum. That was a massive strategic move. It separated the legacy healthcare segment and let 3M refocus on industrial and technology applications. 3M retained a partial stake in Solventum initially, but the key takeaway is that the 3M you're looking at today is a fundamentally different business than it was 3 years ago.
Headquartered in St. Paul, Minnesota, with about 61,500 employees worldwide. The company runs R&D operations in over 35 countries. Annual revenue on a trailing 12-month basis is approximately $25 billion, which is the post-Solventum baseline. And the moat here is real. Decades of compounding R&D have produced a patent portfolio that competitors simply cannot replicate quickly. Customer stickiness across engineered products creates recurring revenue that holds up across economic cycles.
That's the architecture of the business. Now, the reason we're here today, 3M just posted its cleanest quarterly result in years, and the question on everyone's mind is whether this is the start of a sustained recovery or just a good quarter against easy comparisons.
That tension between optimism and skepticism is exactly what makes this one worth unpacking.
William Brown took over as 3M's CEO in May 2023. He came from L3Harris Technologies, where he spent 22 years and rose to president and chief operating officer. L3Harris is a defense electronics company, very different from a consumer-facing industrial conglomerate. But Brown brought exactly what 3M needed, a methodical, engineering-driven mindset focused on cost discipline and operational simplification.
He walked into a genuinely difficult situation. 3M was carrying two massive legal liabilities: the Combat Arms earplug lawsuit, where the company faced billions in claims from veterans claiming hearing damage, and the PFAS water contamination cases, where municipalities alleged that 3M's forever chemicals had contaminated drinking water systems nationwide. Brown's first 2 years were as much about legal triage as business strategy.
And his moves were decisive. He negotiated a $10.3 billion settlement framework for the PFAS claims. He oversaw the Solventum spinoff, which cleaned up the healthcare complexity. He cut thousands of positions as part of a restructuring that significantly reduced the company's cost structure. By most accounts, Brown is viewed as a stabilizer, someone who arrested the decline and is now positioning 3M for a genuine next chapter.
The open question is whether he can also be a growth driver. Operational precision is one thing, Accelerating organic revenue in a diversified industrial company with modest end-market tailwinds is another. But Q1 2026 is the best evidence yet that the plan is working.
All right, Lana, let's get into the financials. I know you've been waiting to tear into these.
You know me. Let's start with the Q1 2026 print because it sets the tone for everything. Revenue came in at $6.3 billion, up 4.3% year over year. That's the headline. On the bottom line, adjusted earnings per share were 2 to 14 cents, beating the street consensus of 2 to 2 cents by about 6%. Not blowout numbers, but for a company in the middle of a transformation, beating by that margin while maintaining guidance is actually meaningful.
And the full-year guidance held up.
Completely reaffirmed. Management is calling for adjusted EPS of $8.50 to $8.70 for 2026. They see adjusted organic sales growth of roughly 3%. And they're guiding to $5.6 to $5.8 billion in adjusted operating cash flow for the full year, with greater than 100% free cash flow conversion. That last number is particularly important. It means almost all operating cash flow is expected to translate into free cash flow.
Walk me through the revenue trend because the quarterly pattern is interesting.
Right, looking at 8 quarters of data, revenues have ranged from $5.95 billion to $6.52 billion. There's some seasonality. Q3 tends to be the strongest quarter as industrial and commercial activity peaks. Q1 2025 was the weakest at $5.95 billion, so Q1 2026's $6.3 billion represents a modest but real recovery. The trajectory is gradual improvement, not explosive growth.
What about margins?
On a trailing 12-month basis, gross margin is 39.5%. That's actually fairly impressive for a manufacturer. It reflects the premium positioning of 3M's engineered products. Operating margin TTM is 19.6%, and Q1 2026 specifically came in around 23% on the operating line, which is notably strong. Net margin is running at 11.1%. The gap between operating and net is partly explained by significant other expenses in Q1, likely related to litigation reserve adjustments that compress the GAAP net income line.
So the underlying business is actually quite healthy.
The core industrial margins are strong. The noise in the GAAP numbers is mostly legacy litigation and restructuring charges. That's why adjusted EPS of 2.4 cents is the number the market is focused on. Solid. Free cash flow for the trailing 12 months is approximately $2.6 billion. Operating cash flow TTM is about $2.96 billion. The company also had $3.7 billion in cash at the end of Q1. The challenge is the balance sheet. Gross debt stands at $12.6 billion, leaving net debt of about $0.8 billion. That's significant. But with $5.6 to $5.8 billion in annual operating cash flow guided for this year, deleveraging is absolutely achievable. Current ratio is 1.59, which is healthy.
What's the valuation look like?
At $157 and change, 3M trades at roughly 30 times trailing earnings. But trailing EPS includes all the noise, so the more relevant number is the forward PE. If the midpoint of guidance at $8.60 in adjusted EPS holds, that puts the forward PE at about 18 times, which is quite reasonable for a high-quality industrial compounder in recovery mode. Price to sales is 3.3 times, which is below peers. EV to EBITDA is around 17 times, again below where you'd expect for a business with these margins if it were operating cleanly.
So the stock isn't obviously cheap, but it's not stretched either.
That's the right read. There's a fair amount of execution risk priced in. If Brown delivers the full-year numbers, the case for multiple expansion becomes real. Overall, 3M's financial health is solid. Strong margins, improving cash generation, and credible guidance, though the elevated debt load from legacy settlements is the main variable to watch.
So what does Wall Street make of all this?
It's genuinely divided. Of 11 analysts currently covering MMM, 4 have it at buy or overweight, 6 have it at hold or neutral, and 1 has an underperform. The consensus is basically hold. The median price target from analysts who've updated in the past 6 months sits right at 166, which is about 5% above current levels. Not a lot of upside implied on the consensus case.
Who are the believers and who are the skeptics?
Barclays is a notable bull. They've been overweight for a while and see the margin expansion story as underappreciated. Wells Fargo also carries an overweight with particular focus on the 2026 free cash flow trajectory. On the skeptical side, JP Morgan downgraded from overweight to neutral back in January, citing concerns about the pace of organic revenue growth. Deutsche Bank went from buy to hold in December and has stayed cautious. And RBC Capital has been a structural bear. They're at underperform and view the current valuation as stretched relative to what they see as modest fundamental improvement.
And the most recent earnings reaction, how did the street respond?
The stock was already up about 3.6% heading into the report. The market was positioned for a beat, and then it delivered one. The positive day of move is consistent with an earnings beat, but also reflects the full-year guidance reaffirmation. The fact that they didn't cut guidance or even just hold the line under tariff uncertainty was seen as a positive signal. Several firms maintained their ratings post-earnings while raising their price targets modestly.
Let me take the bull case, and I've got to say, I find it genuinely compelling. The transformation thesis at 3M goes like this. You had a company weighed down by $20 billion in legal liabilities, an overcomplicated business structure, and a cost base that hadn't been rationalized in years. Brown has addressed all three. The Solventum spin-off simplified the portfolio. The restructuring took out structural costs. The major litigation reserves are now largely established. What's left is a business with 40% gross margins, improving operating leverage, and a clear path to earning $9+ per share by 2027 based on analyst estimates. That EPS growth, from $5.27 trailing to over $9 in 2 years, is a meaningful re-rating catalyst if it materializes. And with $5.6 to $5.8 billion in operating cash flow this year, management has firepower for buybacks, debt paydown, or both.
The bear case is about execution risk and valuation credibility. Yes, 3M's margin story is improving, but 3% organic sales growth for 2026 is not what you'd expect from a company trading at 18 times forward earnings. Peers like Emerson and Illinois Tool Works have earned their premium by consistently delivering above-market organic growth. 3M is still rebuilding that track record. The litigation risk isn't fully resolved either. PFAS and earplug cases continue moving through courts, and the final tab remains uncertain. Then there's tariff exposure. 3M is a global manufacturer and seller. In a world of elevated trade friction, supply chain costs, and demand disruption could eat into those improving margins. And the debt load, $12.6 billion gross, leaves limited room for error if the macro environment deteriorates.
It's a classic recovery trade. You're essentially betting on execution under an uncertain macro backdrop.
Exactly. And the street's hold consensus reflects exactly that ambivalence.
Let's put 3M in context against its industrial peers. Who are we comparing to?
The most relevant comparisons are Honeywell, Emerson Electric, and Illinois Tool Works. All three are diversified industrial companies with some overlapping end markets, though each has a distinct strategic character. Honeywell is the largest at a $145 billion market cap. It's actually undergoing its own strategic split between aerospace and automation. Emerson sits at around $83 billion, very similar to 3M, and has refocused as an automation and technology play. Illinois Tool Works comes in just under $80 billion, with a reputation for exceptional operational consistency.
How does the valuation compare?
On price to sales, 3M trades at 3.3 times, which is actually a discount to all three peers. Emerson is around 4.9 times, Illinois Tool Works around 5.1 times, and Honeywell around 4.0 times. The discount to peers on PS reflects the fact that 3M is still in recovery mode. Investors are applying a restructuring discount. If Brown can get organic growth to 4 or 5% sustainably, the valuation gap to peers could close materially. On gross margins, 3M's 39.5% is competitive, below ITW and Emerson, but above Honeywell. The margin profile is improving, which is the key narrative.
What's the options market telling us about sentiment heading into this quarter?
Mildly bullish positioning. The open interest put-call ratio for MMM came in at 0.65. That's below 1, which indicates more call open interest than put open interest. Not a raging bull signal, but leaning positive. More telling is the implied volatility picture. The April 24 near-term calls were showing implied volatility around 65, which is well above 3M's 52-week IV range of 21 to 49. That elevated IV reflected the market pricing in a meaningful price swing around the earnings event.
And what happens to those options now that earnings are out?
Classic for crush. When you buy options before earnings at high implied volatility and the stock moves less than expected, you lose money on the volatility compression, even if the direction was right. For 3M, the 4% move on earnings day is probably roughly in line with what the options market had priced in, so the crush may be relatively moderate. But anyone who owned April 24 options for a bigger swing will feel the deflation as IV drops back toward the normal range.
Any notable insider activity around the earnings period?
This is one of those quarters where the data doesn't tell us much. We weren't able to pull recent insider transaction records for 3M during this period from our data sources. That said, insiders at large-cap companies with active compliance programs often sit out trading windows around earnings, so the absence of visible activity isn't necessarily a negative signal. It's worth monitoring in the coming weeks as post-earnings blackout windows lift.
Noted. Always good to flag when the data has gaps rather than pretend it doesn't. What are the main risks investors should track going forward?
I'd flag 5. First, tariff exposure. 3M has global manufacturing and global sales. Any escalation in trade barriers adds cost and uncertainty to both supply chains and end market demand. Second, litigation tail risk. The big settlements are mostly reserved, but PFAS and earplug cases are still working through the courts. An adverse ruling or new claim class could reopen the liability math. Third, revenue growth pace. 3% organic growth is the guidance, but the market will eventually demand more to justify the multiple. Watch the quarterly organic growth figure closely. Fourth, the debt load. $12.5 billion in gross debt is significant. Any revenue shortfall could constrain capital allocation options. Fifth, macro sensitivity. 3M's industrial and commercial end markets are tied to global manufacturing activity, which is vulnerable to a slowdown.
And the key metric to watch?
Adjusted operating margin. That's the clearest signal of whether the restructuring is translating into structural improvement or just one-time benefits. If operating margins continue to expand quarter over quarter, the bull case is intact. If they plateau or reverse, it's a warning sign.
So where does all this leave us on 3M?
The transformation is real, and the Q1 2026 results are the best evidence of that yet. Adjusted EPS of $2.40, beating estimates by nearly 8%. Full-year guidance reaffirmed at $8.50 to $8.70, operating margins running above 23% in the quarter. Free cash flow guidance that implies a complete reset from the litigation-era outflows. This is a company that was genuinely broken 2 years ago, and it's not broken anymore.
The stock has a modest valuation gap to peers, decent fundamental momentum, and a CEO who's executing a credible plan. That's not nothing.
The risks are real. Tariff exposure, debt, modest top-line growth, and a litigation tail that hasn't fully cleared. But for investors who want a recovering industrial compounder at a below-peer valuation, with a clear EPS growth path from $5 trailing to $9 plus by 2027, 3M deserves a serious look.
The one metric I'd keep my eye on is adjusted operating margin. If Brown keeps expanding it, the whole thesis holds together. If it stalls, the story needs a rethink. We'll close today with a quote from Mark Twain that feels right for a company in the middle of reinventing itself. The secret of getting ahead is getting started.
For 3M, the hard part of getting started, dealing with the litigation, executing the spin-off, right-sizing the cost structure, is largely behind them now. The next question is how far ahead they can actually get.
That's going to do it for today's episode of Charged Alpha, the S&P 500 Stock Encyclopedia. We covered 3M Company, ticker MMM, the 122-year-old industrial giant navigating one of the most consequential transformations in its history.
Strong Q1 beat, credible full-year guidance, improving margins, and a CEO with the discipline to see this through. Watch that adjusted operating margin.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.